We are talking with Brian Athey from Congressional Capital. Thanks for joining us, Brian.
Happy to be here.
Got a lot of questions for you today.
I'm excited. Let's go.
Okay, perfect. Let's jump right in. Yeah. How should a young person decide between renting and buying in today's market?
I just think they should look at what they're paying for rent every month and figure out, like, look, if I'm paying $2,000 to rent this apartment or $2,300, if I, put a little bit more money towards my monthly mortgage, can I make it work to buy something? I mean, my personal opinion is the sooner you get started buying, the better. I mean, I wish I bought my first house when I was in my mid-30s, and I actually had 3 roommates, and they helped pay the mortgage because they were each paying. The mortgage was like $3,200, and 3 of them paid $800 each, and it really helped a lot. So I recommend that. But if you can't do that, I still recommend try to buy something as soon as possible, because you can always move out, rent it, and then at least you're like establishing wealth, and a nice credit history, etc. So
I agree.
That's what I would do.
It's great advice. What would you say is the most realistic way for someone to buy their first investment property?
I think either buying it with the idea that you're going to have roommates and having them offset your mortgage payment. Maybe you buy a 2-bedroom or a 3-bedroom apartment, even though you're one person, and then you rent the other rooms to someone else. I think that's a super realistic and can be an affordable way to do it. Other than that, again, it goes back to comparing rent, what you're paying for rent versus what you pay for mortgage. And anytime those numbers are close, I'm a fan of buying.
Yeah. And I know a lot of people end up turning a primary residence into an investment property sometimes when they, choose to maybe upgrade and buy a new primary. So it seems like that's a way to get it done.
Yeah, it's a great way to do it. Yeah. I mean, I think that's one of the best ways to do it is to, maybe you're starting off and you can only afford, a 1-bedroom condo or a studio or something like that. You stay there until you kind of progress out of that, either because you've, added family members, you got married or whatever, or just want more space, and then you rent it to somebody else.
So would you say investors should start with single family homes, townhomes, or condos?
I think it depends on where we are in the market cycle. So if you're saying a new investor, if you're sort of more of a homeowner type, or like it's your first property that you ever buy, I mean, I just think you look for an advantage. So right now, in my opinion, like condos are on sale in DC. I think that people are selling them for probably less than what they're worth in a normal market cycle, whereas the single family market's been really robust, and I think you're less likely to get a good deal there. So I would kind of look for the deal as long as it fits kind of what you're trying to do, and start there.
What is the best way to find a great deal as a beginner?
What I recommend doing is, if, say, you live in Capitol Hill, for example, and you're renting an apartment, jog around the neighborhood or walk or ride your bike and write down properties that look like they need some loving and, that need to be sold because somebody's not taking care of them, and then, try to approach the owner. I mean, I always think about, real estate as like, how can you create an advantage? So, in a market where there's a lot of information out there and things are quite transparent, if you can find a property, maybe even meet the owner, and that they're going to move at some point, try to buy directly. I mean, that's always a nice way to buy a property and create some sort of advantage.
Is that where we get those text messages from people like, "Hey, Leah, are you looking to sell your condo?"
Those are more like from the professional people that are buying in scale, typically, right? Because they can afford to do that. There's so many people that are, paying to do mass texting and, mass emailing and doing direct mail, et cetera. But, I'm really thinking about the person who, they want to buy that first property, and get started. It's like, know your neighborhood, know, or even if it's not your neighborhood, but you work near there and you're really familiar with it and you understand values, try to find the diamond in the rough, and then know that you're going to have to figure out how to improve it, renovate it, make it better, but you'll create value doing that.
So would a first-time buyer, do you recommend they live in the property before they turn it into an investment property?
Or live in there while it is an investment property. I know for, a long time, the people would have the strategy of buying a 4-unit apartment building, for example, living in one of the apartments, and then renting out the other 3 as a way to get in. Because, my understanding, although I'm a commercial lender, I don't deal with residential mortgages, but as long as it's 4 units or less, you can go to a regular home loan person and get a loan from a loan on that property, and you can certainly live there, in a 4-unit building and live in one of the units, rent the rest out, or you could buy a single family where there are 3 or 4 bedrooms and live there and rent it out as well. So I think it can be a good strategy to kind of defray the cost of the whole thing.
What is the difference between buy and hold, fix and flip, and what's better for beginners?
Well, listen, a fix and flip is, a lot of people probably seen those shows where, somebody buys something, they show you what the budget is, which is always lower than it really is, in my opinion, and they renovate it and then they sell it. So that's like a classic fix and flip. Sometimes those can be quite simple, where people just do kitchens and bathrooms and do painting, etc. So look, if you really, what's better for someone depends on, kind of who you know. If you have a contractor and you're comfortable having them do the work for like a fix and flip, and you want to try to generate short-term cash flow, say you want to buy something and do a simple renovation and sell it and monetize it 6 months later, that's the way to go. But buy and hold is, you buy something, you rent it out, and then over time you pay down the debt, and maybe you sell it one day, or maybe, like now, if you bought something, rates are kind of high still. Rates would go down over time, so you could probably refinance and pull some cash out, and then, just sort of have cash flow long term and depreciation. And then over time you buy one, and then hopefully you buy another, income producing property, and another. I mean, there's a guy in the city who started buying them when he was at Howard University, and now he owns thousands of buildings. But you got to start somewhere, right?
Yeah. So it really depends on the circumstances.
Yeah. I always tell people the earlier that you can do it, the better, as long as the economics work for you.
And can you break this down for us in very simple terms? What is hard money lending?
I hope so, because I've been doing it for a long time. We've funded over 550 hard money loans. Hard money loans, or otherwise known as private lending, really are alternatives to commercial bank loans. So somebody comes in and says, "Hey, I want to, maybe it's my first house flip, and I've never I've never done a house flip, so I can't get a bank loan because I have no track record." But, say I, work at Booz Allen, and I know a contractor and I know a real estate agent, and this is my plan. We're going to buy it for X, we're going to renovate it for Y, we're going to sell it for Z. What a hard money lender does typically is they look at what the purchase price is plus the construction budget, and then looks at what we call the after renovated value. And most hard money lenders will take the after renovated value, figure out what percentage of that they're willing to loan up to. So in our case, it's usually on a first trust deal 65% of the after renovated value, and so we kind of back into what we would loan at closing plus what we would loan at construction. But the reason people get hard money loans typically is either a lack of experience or simplicity. There are hard money lenders that don't use appraisals. Some do. All banks that I'm aware of, they have to use appraisals, so it kind of slows things down.
Sure.
There's a lot more paperwork involved. So I have some really great borrowers who they're construction people. They don't want to do a lot of paperwork, and so even though hard money tends to be more expensive, they'd rather have the process be simple.
Totally.
And know they can rely on you, and that some appraiser isn't going to reduce the value of something and cause them to have to put more money up or whatever. So hard money's best thought of as a simple, straightforward way for people that are doing development to obtain a loan to buy, renovate, and sell something, or buy, renovate, and hold a property.
So would you say there's less requirements that they need to meet compared to like a standard residential loan?
Oh, for sure, yeah. I mean, some hard money lenders actually sell their loans to Wall Street-based banks, in which case they tend to have similar requirements of like your local commercial bank. And then others like myself are more local, and we don't sell our loans to anyone, so we make up our own requirements.
Makes sense.
So our requirements are going to be less stringent than any commercial bank.
Got it. So Congressional services those loans.
We do, yeah. We keep them, and we service them, and we see the projects through from start to finish.
Can a first-time buyer use a hard money loan to buy their first home?
Not if they're going to live there. So hard money lenders are commercial lenders, so we don't loan money to consumers. So if you're a consumer out there, and I get this question from real estate agents a lot. In fact, it's often in the form of, hey, I have a buyer who has a bunch of cash, but they moved here from Europe or somewhere else around the world. They don't have a long track record of employment here. They're going to buy this $2 million house in Potomac, but can you give them a loan because they don't have bank relationships here? And the answer is always no, not if they're going to live there. So we do exclusively commercial lending. So it can be a residential property, meaning a single family home, but somebody has to be doing it for business purposes.
Got it.
So if somebody wants to, the minute that we hear somebody wants to live there, have it be their residence, we don't do the loan.
Got it. Okay. That's so interesting. When should a first-time investor consider using a hard money loan?
Yeah, my opinion is that it's often, the best route for first-time investors because good hard money lenders can help them. I mean, if you're a first-time person who's buying and renovating, or their plan is to buy, renovate, and sell something, you can kind of say to them, "Hey, look, I've been doing this in DC for a long time. For example, have you looked to see if there are heritage trees on the property, or have you looked to see if there's a solar panel next door?" Or, there's any number of pieces sort of advice that a good hard money lender can provide. A first-time investor that really banks aren't set up to provide that kind of advice. I mean, even if they know it, know those kinds of details, which many of them don't, they're just doing too much volume. They're not as kind of in the weeds. But, I think hard money is often a really good option for first-time, investors.
How does a lender like Congressional Capital determine whether or not someone qualifies for a hard money loan?
Really, it's asset-based lending. So we look at the deal. I say that on the one hand, but also the thing that I actually start with is the person. I want to make sure that I like them, I trust them, I think they can execute, that they have a clear plan, and that their plan makes sense. So they don't necessarily have to be the most experienced developer in the world, but if they're not, they certainly need to have a really good team.
Yeah.
So I often tell newer developers, look, make sure you hire a really good architect. Make sure your construction person's done this kind of project over and over again because, you can easily make mistakes if you're trying to cut corners in those areas. So, we look at the person, kind of sort of interview them first, and then we look at the deal to see if it makes sense, and then we kind of, sort of put it all together to make a decision.
So is it more asset-based and less based on creditworthiness or income?
Well, sure. It's definitely way more asset-based lending. The hard money lenders typically look at, the person's ability to execute the deal and will the fundamentals of the deal stand on their own, irrespective of the person's, credit history, et cetera. But you're always thinking about, do I trust this person? Do I think they can execute? Are their intentions good? So it's a mix of both those things, but it really is asset-based lending first and foremost.
What are some of the differences between hard money loans and traditional lending?
Yeah, the traditional commercial bank, I'm on the board of a traditional commercial bank, and I'm on the loan committee. I know a lot about how traditional commercial banks function. They do many things really well, but there's certain things that hard money lenders do, I would say, better, which is speed. I mean, at our company, we've closed loans in as short as 3 days before.
It's amazing.
Right, and so I had a call, I don't know, maybe 9 months ago from a borrower who I've known for years, who had never done a loan with us, who borrows from local banks and maybe other hard money lenders, but I'm not sure. And I think it was like a Tuesday night. He kept calling me, and I was like, "Why is this guy calling me?" And basically, his bank loan had fallen through, and he had to close by Friday. And it was a really good deal, and he's a good person. And so we just kind of, got moving quickly, and then we closed 3 days later. I mean, I've probably done that, at least 10 to 20 times in my career now. So speed for sure, flexibility. I mean, I would say most hard money lenders are going to be a lot more flexible than local commercial banks. Way far less paperwork required during the process in the beginning. I mean, we still require all the obvious things like insurance on the property and anything else you'd sort of expect any lender to require. But we're not going to require nearly as much paperwork and front end work on a borrower's part. So I would say speed, flexibility, and lack of sort of spending a bunch of time doing paperwork that may or may not be necessary.
It makes a big difference.
Yeah.
So how much money does someone need to put down for a hard money loan?
Yeah, well, at my company, the answer is it depends. It depends on the deal. It really depends on the math of the deal. So we loan acquisition plus construction no more than typically 65% of the after renovated value. So if that math works such that the acquisition amount plus the construction is 65% or less of the after renovated value, they may put very little down or nothing down. We've had that happen before. But I've also had deals happen where a borrower put down, a substantial amount of money. So it really depends on the specifics of the deal. I do know that if you're looking at other hard money lenders, that some of them do require certain percentages down that are fixed. I know one in the area sells loans to one of the Wall Street-based funds, and they require, I think it's 15% down. But I think it's incumbent upon borrowers to ask that question early on, so you're really well aware. So, I always say borrowers should choose whomever they're most comfortable with. find the best deal that works for them and in terms of what they're looking for. But, that what one hard money lender in the market requires to put down will vary very differently from another.
Got it. Okay.